Hi everybody, welcome back to Chapter 19. In this video, we'll begin a discussion on accounting for stock options. Stock option plans give employees the option to purchase A specified number of shares of the firm's stock, B, at specified prices, C, during a specified period of time. One of the most heated controversies in the standard-setting history has been the debate over the amount of compensation to be recognized as expense for stock options. At issue is how the value of stock options is measured, which for most options determines whether any expense is recognized at all. Historically, stock options have been measured at their intrinsic values, the simple difference between the market price of the shares and the option price at which they can be acquired. For instance, an option that permits an employee to buy $25 per share stock for $10 per share has an intrinsic value of the difference between the two of $15. However, plans in which the exercise price equals the market value of the underlying stock at the date of grants have no intrinsic value and therefore result in zero compensation when measured this way, even though the fair value of the options can be quite significant. So, after an extended battle, the accounting rules have changed. We now measure compensation as the fair value of the stock options at the date of the grant, and then record that amount as compensation expense over the service period for which employees received the options. Estimating the fair value requires the use of one of several option pricing models. These mathematical models assimilate a variety of information about a company's stock and the terms of the stock option to estimate the option's fair value. The models should take into account the following: exercise price of the option, expected term of the option, current market price of the stock, expected dividends, expected risk-free rate of return during the term of the option, and expected volatility of the stock. As you can see, it is not easy to measure an option's fair value. Illustration 19-3 in your textbook is an example where Universal Communications grants 10 million options to key executives at January 1st, 2021. The options permit the recipients to acquire 10 million of the company's $1 par value common shares within the next 8 years, but not before December 31st, 2024, which is the vesting date. The exercise price is the market price of the shares on the date of grant, $35 per share. The fair value of the options. The book is not asking you to calculate this difficult computation. It's giving you the fair value of the options, estimated by an appropriate option pricing model, is $8 per option. So on January 1st, 2021, there is no journal entry required. That's the date of the option. But we do need to calculate the total compensation expense. The estimated fair value of the option is given to you at $8 per option. And there are 10 million options. So the total compensation is $80 million. We will need to recognize this total compensation over the service years within the vesting period. The options were granted on January 1st, 2021, and They vest on December 31st, 2024. So we need to count 21, 22, 23, and 24 for a 4-year vesting period. And we will recognize this $80 million of compensation over the 4-year vesting period. The top of this slide simply restates the same facts that were given to you in the prior slide. And $80 million divided by 4 equals $20 million of compensation expense per year that will be recorded in this journal entry on December 31st, 2021, 22, 23, and 24. Debit compensation expense, $20 million. Credit paid in capital, which is an dash stock options, which is an equity account, $20 million. Let's work a concept check problem. On January 1st, 2021, Parker and Ryan Insurance Company granted 30,000 stock options to certain executives. The options are exercisable no sooner than December 31st, 2023, and expire on January 1st, 2027. Each option can be exercised to acquire 1 share of $1 par value common stock for $12. An option pricing model estimates that the fair value of the options to be $5 per share or per option on the date of grant. The market price of the company's stock on January 1st, 2021 was $14, and on December 31st, 2021 is $15. What amount should Parker and Ryan recognize as compensation expense for 2021? Please pause your video to do the calculations and select your answer. Is it A, $10,000, B, $20,000, C, $30,000, or D, $50,000? Once you have selected your answer, restart the video to check your work. The correct answer is D. The market values of the stock given to you in the problem are not needed for the solution. Simply multiply the market value of the option, $5 per share or per option, times the number of options, 30,000, equals total compensation of $150,000, and then divide by the 3 years in the vesting period. 2021, 2022, and 2023 is 3 years in the vesting period. That gives you annual compensation expense of $50,000. Well, that's all for this video. In the next video, we'll discuss accounting for estimated forfeitures. See you next time.